Hi, this is Matt Lewison with Resi Fund's market update for the March quarter of 2019. There's a lot happening in the market at the moment with an upcoming election. There's a lot happening in the finance space, tight credit conditions. We've all been reading in the paper some of the challenges that we're facing in the residential property market around Australia. Now the thing is, it's very different going from state to state, city to city, but there are some fundamentals at play that are affecting all or pretty much most of the markets at the same time. So I'm going to run through some of those fundamentals, going to look at what we think is happening in the market, where we think it might go in the future, and where Resi Fund's focus is going to be over the next few periods. This presentation is obviously our view of the market. We've drawn on statistics from ABS, from demographers and economists. Obviously we're stated on the charts. But I guess one of the key things to keep in mind is that if you're going to make an investment decision about investing in the property market or in any financial product, that you really need to do your own homework as well. Don't just rely on this market update. So we came into 2019 thinking that the first half of this year was probably going to be the toughest market conditions that we'd experienced in a few decades, pretty much since the 2000s. We haven't been wrong. It has been very, very difficult for a number of reasons. But despite that, we're in a very good position, and we think that there's a lot of developers, a lot of investors who are in a great position now to move forward and to benefit from the market gains that might be in front. And there could be, and there probably will be some negative growth still to come through. But keeping in mind that in the past 30 years, the longest downturn has gone for about 28 months. We're over 21 months into this downturn already. We've seen hopefully the majority of negative growth. And some of the fundamentals that are at work should help to see us come out of that downward trend very quickly. And certainly there are markets that have defied that trend for reasons that I'll go into very shortly. But I guess the key thing to remember is that after each of the previous downturns, going back over 50 years, the next 5 to 6 years have generally been very strong. When you look at the GFC or post-GFC, Melbourne, Sydney, a couple of the other markets have seen huge growth since then. When you look at the post-GST changes, after that we saw a number of years of very strong growth. And again, through the 90s as well, after a very soft start to the 90s, we saw very strong growth through the 90s. So generally after these downturns, and again, you don't have to look at the US that saw a very strong downturn, the last 10 years have been extremely solid in the US. So we have to remember that market cycles are just cycles, and that we need to look for signs that I guess are going to drive the next change in the cycle. But hopefully, if you've gone through a correction, generally coming out after that, it might not be as rapid growth, but it should be longer and sustained growth. And again, I'll explain a little bit about why we believe that it is going to be good sustainable growth coming out after this cycle. So what are the fundamentals that are at work right now? First of all, interest rates are at, well, you can actually borrow for less than 4%. Yes, the RBA may reduce the interest rate again in the future, and certainly if you look at the ASX 30-day interbank cash rate implied yield curve, so it's a mouthful, but essentially that's the rate that the banks are exchanging money at. They're forecasting that there is going to be at least one rate reduction in the next 3 to 4 months. Is that going to have a huge impact on the market? Probably not. We're already seeing very low interest rates. People who can access credit are borrowing at a very low rate, some of them down to about 3.5%. But they're being assessed at 7.25% by most of the banks. So if that assessment rate doesn't come down, the lower interest rate's not going to have a huge impact on the property market, although it will make it cheaper for those with loans to be able to service their loans. There's a strong jobs market. Australia's unemployment rate is at 5%. If you had said Australia's unemployment rate was going to be at 5% 20 years ago, people would have been thinking that was just, there was nobody available in the market and that wages would be going up a lot. Wages aren't going up, but it is a very strong jobs market nonetheless. Is it going to continue to improve? Well, there's so many different forces at play. We don't have a view on that, but certainly if construction starts to pick up again, then that'll help to ensure that the unemployment rate doesn't jump up considerably. There's high population growth. Again, this is probably one of those things that's offsetting wage growth a little bit, but the high population growth is here to stay. It's a very solid reason why we have high population growth, because taxes would go up a lot if we didn't have high population growth. We've obviously got a lot of baby boomers, some of the biggest transition to retirement coming up over the next decade, and as those baby boomers and the retirees draw on the services within our country, but the government funds, the government obviously needs to replace, first of all, the taxes they were paying, but also help to fund all the extra services that they need to provide. So that's one of the main reasons why we have very strong population growth, and the government isn't in a hurry to change that. And finally, one of the big things that might not be coming up on everyone's radar is that we have tight vacancy rates or rental vacancy rates in nearly every capital city, or at least they're tightening in nearly every capital city. Probably the outliers there are Sydney, and also Darwin is heading in the opposite direction. But I'll go into a bit more detail on each state. So remember, as we go through different market cycles, and I'm not suggesting go out and buy property, but you have to keep in mind one of the greatest investors of modern history, Warren Buffett, says that be greedy when others are fearful and fearful when others are greedy. A few years ago, everyone was being greedy. They're all out there pushing up prices. Now prices have corrected, and those that are willing to act may be able to pick up property or capitalise on the next upswing in the cycle. Again, it's for you to do your homework on and make sure that you are looking at a lot of information and not relying solely on this presentation. So let's have a look at Sydney. So we're going to look at 4 different factors for each of our major capital cities through the course of this presentation. So Sydney, looking at construction. So we've obviously been through a huge construction boom over the last 3 to 4 years on the back of the high price growth. And despite the fact that we've had that construction boom, I guess we've peaked in that construction boom. So over the next year, we're going to start seeing less and less completions. But we have already been seeing vacancy rates increasing. They went from 2% in 2017 up to 3.1% now. As the completions and the current huge volume of work comes through, we expect that vacancy rate might continue to go up. That's great for renters because it means that there's a little bit less pressure on the rent, and it's probably one of those reasons why we think that Sydney is going to take a while to correct or come out of this softer cycle. We'll certainly be watching the vacancy rate, and that's one of our key indicators. Population growth is really strong, so that'll help to correct the vacancy rate, provided it doesn't start getting moved elsewhere. Obviously, there is a bit of talk about the City of Sydney needing a lot of infrastructure work to help maintain that population growth. But our assumption is that population growth into Sydney will remain pretty stable. And as I said, that'll help to reduce the vacancy rate once the construction activity has well passed and started to diminish. Also employment or unemployment. Unemployment's at about 4.3% in Sydney or in New South Wales. That's the lowest in the Australian market for the major capital cities, and that's a very low unemployment rate. So obviously that's one of the things that helped to push up prices as well, that there was really strong, solid jobs market. So our view on Sydney is that growth's unlikely until the supply and the new supply is absorbed. So many people say that a 3% vacancy rate is a balanced market for rentals, but obviously if vacancy rates are going up, then it's trending towards a tenants market and an oversupply. When vacancy rates are coming down and it drops below 3%, it starts to move into a landlord's market. But we actually think it needs to get down to about 1.5% or close to 1.5% before you actually start to see any impact on prices. And again, I'll talk about some of the other markets and we'll see exactly how that's playing out. So on to Melbourne. Construction again also peaked in 2017, and we're now moving past the peak. And despite the fact that we've had this construction boom, the rental vacancy rate in Melbourne stayed pretty steady at about 1.7%. That's obviously a pretty good sign in our minds that the supply is being taken up pretty quickly. So even though prices have been quite soft in Melbourne, there has been, I think, up to about a 10% price correction in the median, the actual supply to demand equation looks pretty good. So that tells us that as the construction activity starts to ease off and there's less completions coming through, the vacancy rate will probably drop rather rapidly if population growth stays at around that 100 to 140,000 over the last 12 months. And if that maintains, then obviously the vacancy rate's going to drop to that 1.5% mark fairly quickly. It might be about 9 months, but that's obviously one of the key factors. And it's obviously vacancy rate's not uniform across a city, but certainly in the areas where there's affordable housing in terms of the urban fringe and suburbs, that vacancy rate is quite tight. So we'll expect to see rents going up perhaps later this year to early next year, and that's going to be one of the drivers of the next market cycle. Again, with Melbourne, similar to Sydney, very tight unemployment or strong employment. It's about 4.6% for Melbourne. So our view on Melbourne is that the downturn could be short-lived. And I know that's a little bit contrary to perhaps what some of the economists are saying. And I guess the reason why that's our view is, again, coming back to that rental vacancy rate and the supply to demand equation. There's less things getting built now. It's harder for developers to build apartment projects because they're not getting the pre-sales. There's a lot of things impacting that, the availability of credit. Banks don't lend unless you can get pre-sales, and buyers are a bit shy of signing a pre-sale contract now for a number of reasons, including the fact there's an upcoming election, but also because the finance regime and the assessment criteria has changed so quickly over the last few years that if they sign a contract 2 years before completion, they don't know if they'll still be able to get finance when it comes time to settle. So that's had a huge impact on the number of projects that are getting started. That obviously flows through to the fact that a year and a half to 2 years down the track, there's a lot less projects being completed. And if population growth maintains at the same rate, that vacancy rate drops really quickly. So that's why we think that Melbourne's downturn could be very short-lived. It's different to the Sydney market insofar as Sydney's vacancy rate is going up, Melbourne's staying steady and is probably going to start dropping sooner. Brisbane. So Brisbane peaked in construction in 2016. It's well down on its construction peak. Vacancy rates as a result dropped from 4% at the start of 2018 down to just 2.6% in March 2019. So in about 15 months, it's dropped from 4% to 2.6%. There's nothing that suggests to us that that change in vacancy rate and that rapid tightening of rental vacancies isn't going to continue. We believe it will continue, and it won't be long before it's dropping under 2%. Brisbane's seeing very strong population growth again now. In fact, the strongest population growth of the last 5 years, and I think it's up over 80,000 in net population growth going into Queensland. Unemployment's probably the one thing that's held Brisbane back a little bit. It was over 6% not that long ago. It's dropped down to 5.9%. This is actually one of those things that the Brisbane market is creating, or Brisbane is creating a lot of jobs. There's a lot of infrastructure work. There's some major commercial projects happening as well. But offsetting that is the fact that the very high population growth means that there's more workers entering into the market, and that's offsetting the new jobs that are being created to keep that unemployment rate high. So it's very hard to calculate, I believe, the unemployment rate when a market is growing quite quickly, because population stats are 6 months old and employment stats are 1 to 2 months old. So you're comparing 1 to 2 month old data with 6 month old data, you don't actually know what the actual population is on the day that you're calculating the unemployment rate. So that's one thing that we're sort of very mindful of in those rapid, fast growing states, but certainly a lot of the indicators are favourable for Brisbane. And also there was a lot of talk about an oversupply in the Brisbane market a few years ago, and we certainly don't dispute that. However, a lot of the projects that were approved or potential never got off the ground. Construction costs made them unviable. So there's a lot less stock coming through in the Brisbane market, and that's one of the other reasons why the vacancy rate, particularly in the inner urban areas, has reduced so quickly. And certainly our property management team up in Brisbane are telling us that they've seen rents go up about $15 a week on a $400 a week property over the space of a couple of months. So that's pretty good price growth for rents. It's obviously in isolated spots, it's not uniform yet, but again, we expect that Brisbane's going to be a strong performer in that rental market over the next couple of years. So I guess just tying that together, the other thing about Brisbane is that it didn't have a lot of the price growth that Sydney and Melbourne had, despite perhaps some really good favourable characteristics to that market and fundamentals. But the things that I guess were going against it were the fact that Melbourne and Sydney were both booming. So a lot of investors were focusing their money into Melbourne and Sydney and ignoring Brisbane, which at times is considered to be the poorer cousin to the larger cities. So that's obviously no longer the case. So those cities have softened, and certainly investors are looking elsewhere now for the next growth phase. Also, the unemployment rate was high and there was an oversupply of stock. So those things have started to correct. Certainly Melbourne and Sydney prices coming off are favourable for Brisbane. The jobs market is improving. Population growth is improving, continuing to get stronger. And yeah, I guess a lot of those things pointing to a strengthening market in Brisbane once some of these capital constraints start to ease as well. On to Perth. So Perth's been on a downward trend for about the last 4 to 5 years. It's been a very long downward spiral with over 20% price correction in the median house price. Construction activity, probably in this case, rather than talking about it peaking and coming down, being something that might be favourable for Perth, what we actually want to see in Perth is construction activity picking up, because that means there's more jobs. The unemployment rate in Perth is still quite high. It's improving slowly, but it is up around that 6% mark, or 6.1%, I believe. So we want to see construction picking up, and that's obviously an early sign as well that people are building more houses. We want to see construction activity in that residential space. Vacancy rates, well, vacancy rates have dropped from an incredibly high peak of 6.6% to down to 2.9%. And that was over the course of about 2 years. So that, again, has been a huge factor in Perth's property market, that they had really high rental vacancy rates. They actually had negative growth in rent. So for an investor outside of Western Australia, thinking, well, where's the best place to put my money? It wasn't over in Perth for a number of years, because the investors are saying, well, if I invest in Perth today, there's a chance that I won't find a tenant, so I'll have zero cash flow or negative cash flow on my property, or there's a chance that the rent I'm expecting will go down and prices might continue to go down. Certainly there's been talk about Perth bottoming out for quite a few years, and it hasn't quite got there. It's still trending down, albeit much slower. But with that vacancy rate being much tighter, we think it's not that far from the bottom now, and we expect to see more construction starts in houses picking up in the near term. Population growth's been another one. Obviously, Perth still has positive population growth overall at 22,000, or around 22,000, but it's had negative net interstate migration for a number of years. There's all the people who moved to Western Australia for the mining boom were moving back to the East Coast over the last few years. So that was obviously a drain on population, and obviously contributed to the rental vacancy rate being quite high. And now that there's more jobs being put on in Western Australia, that exodus has started to slow down. Certainly there's capacity for more people to move back to Perth as well, who might have left Perth to go chasing jobs on the East Coast and might see opportunities now to head back to Perth. But again, this picture starts to tie back into the supply of stock. We call Perth a bit of a tortoise and hare market. So when the market booms in Perth, it booms quickly, and it booms for a very short period of time. It can be 2 years, maybe 2.5 years. And it can see quite rapid price growth and high growth in that period of time. Then it has a pretty slow unwinding period. So that's unfortunately the tortoise, where we see it starting to correct, but it takes a long time for that to happen and for it to get back to a point of equilibrium. The one thing that might impact Perth coming out of this downturn shortly is the fact that there is still a lot of titled stock of land sitting around. A lot of developers have been putting land out and developing it, knowing that they can't sell it unless it's built. So we've got that titled stock, and we also have a lot of developers have approved stages up their sleeves ready to go when sales start to pick up. So that'll probably dampen any price growth, but the first sign of it will be a pickup in construction activity and in land sales as well. On to the other capitals. So we've got Adelaide, and I'm just going to talk about a couple of very high-level stats here. So we've got Adelaide at 1.1% rental vacancy rate. We've got Hobart at about 0.4%. So Hobart's been under 1% vacancy rate for a couple of years now, and I'm going to show you a chart in a moment that looks at the price growth for each of these cities comparable to the other capital cities of Australia. Canberra's at 0.9% and Darwin is at 3.7%. So out of those 4 capital cities, pretty much 3 of them are at or below around 1%, and Hobart is up at 3.7%. So it's a little bit higher than Sydney for Darwin. When we look at this chart, what I want everybody to remember or focus on is that those capital cities with vacancy rates below 1.5% are the capital cities that have the highest or actual positive price growth, despite the fact we're in the worst downturn in Australia in 30 years. So access to credit is just as hard in Hobart as it is everywhere else in the country, because the assessment criteria is the same. But Hobart's still been able to produce over 6% positive price growth in the last 12 months. In fact, Hobart's actually been the best performing capital city in the last 5 years as a result of the tight vacancy rate. So even though it's tight, they're trying to produce more stock to cope with that. They're unable to produce enough, and that vacancy rate's been sitting at that 0.4% mark for some time now. It was about 0.7%, if memory serves me correctly, about a year ago. So why is this important? Well, when the vacancy rate for the other capital cities drops below 1.5%, we're going to start to see a very different market cycle. What I believe and what we believe has been driving the market for the last few years has been a top-down market cycle. And I'll explain a little bit about what that is. So a top-down market cycle is when access to credit is very easy for a lot of the market, and when there's new entrants to the market and they're buying mid to upper level properties, bidding for properties and dragging up the price. And that does have a habit of pulling up the bottom prices as well as competition picks up, and there's a bit of a firestorm almost of buyers wanting to buy property and fearing that they might miss out. So that's a top-up market cycle. We think that when the market and the rental vacancy rate is below 1.5%, it actually moves into a bottom-up cycle, and a bottom-up cycle is much more sustainable. And again, that's shown by the fact that the three capital cities with less than 1.5% vacancy rates are growing despite being cursed with the same capital constraints as all the other cities. So let's talk about the bottom-up market cycle. So the bottom-up market cycle starts with an undersupply of stock. And again, that's evident by the fact that vacancy rates are very low. Because generally, if properties don't sell, if there's a surplus of stock in general, even if they weren't investor stock to start with, if you can't sell, you generally switch it over and you rent it out, and that increases the vacancy rate. Vacancy rates are low because there's just a tightness of property generally. Then we move into rental growth phase. When there's tight vacancy rates, rents start to go up. In Hobart, they went up by more than 10% in 1 year. So imagine if you're paying $350 a week rent for the average property in Hobart, and the next week your rental statement or your rental review statement comes through and the landlord just put the rent up by $35 a week. So overnight your rent goes up by $10 or 10%. That has a huge impact on your psyche as a tenant, as well as to the landlord who's seeing their income improving by 10%. That obviously sees yields improve for investors as their cash flow improves and their serviceability is also improving. Improved yields and rental growth have a few different impacts. So for a tenant who's a prospective first home buyer might be saving for a deposit, you're going to be much more motivated to get out of that rental market and start buying your first property. You've obviously got some incentive from the government or some extra cash available through the first home buyers grant. So you're going to start to try and get out of that market because your rents have gone up so quickly you're worried about it happening again. If I go back 20 years, I remember being in exactly the same situation and my rent going up and thinking, I don't want to be paying more rent to my landlord next year, I want to be out of this place. So that's obviously impacts by bringing more first home buyers into the market. The second impact that it has is on investors. Investors' cash flows improved, the yields improving, their confidence is up, so investors become more active as well because they want to capitalise on this really strong cash flow market and the fact that rents are going up in the future. As the rent goes up, it also helps them to pay down their debt faster, which gives them more access to capital and equity to buy their next property. And then as a result of those two forces, that's when you start to see price growth. And because it's two different market demographics pushing the market up from the bottom, normally it starts at the affordable end of the market and it starts pushing up from the bottom. It's more sustainable than a top down. And one of the reasons for that is you can't change supply very quickly in a big capital city market. It takes years to start to deliver the supply that you need. And again, Hobart's a prime example. You look back 2 years, their vacancy rate was already at 1%. 2 years later, it's at 0.4%. It's going to take a couple of years to get out of that and get it back up to a level where vacancy rates are above 1.5% again. So those bottom-up market cycles generally have a long time to play out. And the other thing that it also does is once you're in that market cycle and construction activity does start to pick up, there's more jobs, there's more confidence, and then it starts to free up capital as well because lenders start to be a little bit more confident about borrowers' ability to continue to service loans in the future and that prices won't be going down and moving borrowers into negative equity. That then leads back into that mid to upper level of the market starting to become more active as well. So we think we're heading into a very interesting time. There's obviously some other things that are going to come into play. We've got an election very shortly with one party looking to make some significant changes to the tax regime, particularly affecting investors of property, and the other party obviously sitting on the fence in that regard. And certainly, while we don't dispute that Labor's proposed changes would have an impact on the market. We think that it's not going to be uniform across all of the market. It might impact investors of apartments more so than housing. Apartments are larger. A lot of apartments are designed for investors. So apartment buildings that have been designed for investors are probably going to have difficulty, whereas apartment buildings designed for owner-occupiers with larger floor plans that have owner-occupier appeal are going to have an easier run. Obviously houses, the majority of the secondary market in houses is actually owner-occupiers anyway. So taking away negative gearing for a secondary purchaser of a house doesn't have a huge impact on that housing market. So we're going to see some changes in that. It's not all going to be doom and gloom, because at the end of the day, anything that's going to reduce construction further, it might affect prices in the short term, but it's actually going to push up rents a lot sooner, and it's going to mean that that next bottom-up market cycle will come back into play in the near future. So what's our focus? We're going to focus on the large markets. So despite the fact that I think that there's still some price growth and rental growth in the smaller markets of Hobart, perhaps Adelaide and Canberra, we're still going to focus on the larger markets. One of the reasons for that is that the larger markets have a little bit less competition right now. We're also going to focus on the larger markets with tightening supply. So we're not looking at Sydney because we think that that supply is still running out. It's going to be pushing into higher, perhaps even close to 3.5% rental vacancy rates. And it's got a bit of a time before it comes back down to a level that we think is going to have an impact on rents and prices. So we're going to be focusing on large markets with tightening vacancy rates where there's less competition. So at the moment we can go and find the stock that we want in those markets without competition, and we can get them for a very reasonable price. If I want to go and find the stock that I want in Hobart, it's going to be very hard because there's a lot of competition. So I would have to settle for stock that's not ideal for me just so I can participate in that market. And our view is we're long-term investors, so we don't just want to participate in the market. We want to hold the right type of property, the right type of stock, and we want to hold it for a long time. And we obviously want to then capitalise on the rental growth. Then we get the rental growth and we're going to get more of the upswing in the market cycle. And keep in mind, despite the fact, again, Hobart has had a low vacancy rate for some time, still has price growth ahead of it. It's been in this cycle for some time, and some of that activity for construction and to correct supply is already underway. There's developers going through planning permits, and there's things in the works that will help to bring it out of that market cycle, I guess a lot sooner than the next phase for Brisbane, for instance, which is going to have a long run in front of it. So that's our market update. I'm sure that some of our views are probably a bit different to what you might hear in the marketplace and certainly what you might hear in the media. A lot of them are also backed up, and I've been seeing interesting articles coming out from economists, from bankers, from property specialists, from industry communities and government and industry think tanks that are all pointing in the same direction. There's a lot of concern about rental vacancy rates and the tight supply in the market right now. And it will be interesting to see how we come out of this next election, and I guess it'll give us a good opportunity to talk to you again in 3 months and look at where we think the market might go after the resolution of the election. Thanks for your time.